Hello and welcome to the TechGig podcast, folks. I'm Sukriti Advanshi, your host, and in this episode of the podcast, we're going to talk about how customer data drives product development in the digital lending space. And to fill us in with lots and lots of details about this, I have with me the CTO, Giridhar Yasa from Lendingkart. Welcome to the show, Giridhar.
Thanks, Sukriti, for inviting me to TechGig. I'm quite excited to be a part of your podcast series.
I am also indeed very excited and elated to have you on the show, Girdhar, and I'm very curious to know the answers of the questions that I have for you today. So let's get started. The first one that I have for you is that technology has captured every industry today. How do you see this tech invasion in the finance sector?
Right. So, Sukriti, I think technology is very visible, right? I mean, it's really an outcome of thoughtful problem solving. So, while we say that it has captured every industry, it's been within us, it's been around us over time. And it's not really one thing, but more about an evolution of how we solve problems. And it's really a mindset. I mean, one example is when people started using wheels, right? That was technology. We would have bulky computers at home, and then they sort of moved to laptops, and now we have mobile phones, which are significantly more powerful than computers that we've had in the past. That is technology. So essentially, you're right. It has captured every industry, and this has flown into the finance sector as well. And it's quite visible in the finance sector. I mean, a few years ago, you wouldn't have been able to imagine transferring money real time, right? At small ticket sizes, probably. Now with UPI, it's very ubiquitous, and it has made payments and exchanging money unbelievably easy. I mean, think about it, right? You would have to go to maybe a post office and do money orders, or even when there were online bank transfers, it was non-trivial. I mean, someone who is living in a different city, they probably have to go to an internet cafe for doing a bank transfer. They would be wary and jittery of, how to do that. So they would probably walk into a bank to enable a bank transfer, where you'd probably have to fill in a slip, right, to transfer money to someone. So yeah, I think it's very visible, and whenever these changes happen, right, it's very stark, it's big, and it's in your face. And I think as far as we are concerned in the finance sector, it's our responsibility to make sure that the experience that these technological innovations are bringing in, those are bettered over time, and our stakeholders and customers are experiencing all of it and very happy about it. So I think that's how I would put how this innovation has sort of taken over the finance sector. And then if you talk about Lendingkart alone, right, and the area that Lendingkart works in, unsecured finance, we need bank statements of customers to look at their credit worthiness. The recent account aggregator launch is a big leap. We were the first in the country to be a financial information user of account aggregator ecosystem. It's also a lot of problems, one of sharing data reliably, sharing data in a secure fashion with extremely low friction in just a few minutes. I mean, think about the amount of time it would take for someone to maybe complete a loan application with our app now and account aggregator ecosystem that's been promoted by RBI and Samati. You could complete a loan application within a few minutes. Earlier, you would have to talk to an agent. They would introduce you to a bank manager or an NBFC manager. You would go back and forth for documents and eventually probably get disbursal. And that would be very challenging in itself, right? It would be a multi-day process. Similarly, even after disbursals, payments itself was a challenge. Even if you wanted to pay on time, do you do it using checks? Do you put it in a Dropbox? Would you miss a payment? How can you reach out to a bank to pay? Now, there's someone available on IVR, and then you get a payment link, and then you immediately pay, again using probably UPI. All this, right? I mean, all this technological evolution has happened fairly recently, especially in the sectors that Lendingkart works in. This is despite core banking systems existing for quite some time, NEFT, RTGS kind of constructs existing in the ecosystem for quite some time. So overall, I think, in the financial sector, the anxiety of an individual, right, particularly in the MSME sector where Lendingkart works in, that anxiety of a customer has reduced because of technology, and we are very happy to be at the forefront of that.
So Gitar, in short, this invasion is a positive one, and people are actually trying to take the right advantage, and the industry is actually giving them the right method to take the right advantage of this invasion. I hope I'm right on those lines, right?
Absolutely, and it's just going to get better.
Yes, fingers crossed, and let's hope some more, positiveness, because the kind of cyber threats that are existing these days, I'm sure a more refined process is something that every customer is trying to look at. Now, tell me, do you
Of course.
believe that data-driven decision making has actually changed the way how companies function these days?
I think data-driven decisioning, Sukriti, has been there for quite some time, right? I mean, uh, people have been collecting data for quite some time. Companies collect data on their customers, their behavior. What's important is how they use that data, and typically that is followed by a qualitative debrief, of analysis of the data, and that's how decisions have already been always been taken. Now, companies that don't do this, they slowly die, right? What has really changed, I would say, is the way the data is gathered, consolidated, and how you make sense of that data, right? And models of how this has happened, how this process has evolved, has changed and evolved quite a bit. There's a lot that goes behind, right? First of all, you need the systems that you're operating on to be configured to collect data. Then the process of collecting data itself is massive. Do you allow losses while you collect data? Is it okay if a part of the data doesn't reach you? Are there streams of data wherein you cannot tolerate losses, and it has to be a non-lossless channel? Then verifying the correctness and the completeness of data, that's a big one. People worry about extracting the right kind of features to look at in the data, which again it's not very data specific, but it is more domain specific. It's more business specific. In modern machine learning terminology, that's called feature extraction and feature engineering. We do that a lot in our own systems. Finally, you have to manage the resources that can process this data. There's a lot of legacy systems probably that you have, from and maybe disparate sources, and you have other stakeholders that exchange data with you in a secure manner. How do you sort of bring all of this together? That's an important one. Finally, you need to create a decision framework, right? Now, the decision framework could be, maybe I'm looking at some a pattern and creating some rules. It could be a machine learning model, which is numerical analysis based and statistics based. It could be something very sophisticated that involves AI, right? Finally, you also need to monitor how the system is performing, and you would have to do that on an ongoing basis. And two fundamental things there as well, right? One is, how is the system performing in itself, and how are the results of the system that have been recommended over time, how are they doing? It's more short-term analysis as well as long-term analysis that is there. So I think this multi-stage, multi-step process around how data is being used, right, for achieving that business objective, that has evolved quite a bit, and that is what has really changed Sukriti in data-driven decision making.
All right, thanks, Gita. I think that actually makes sense. I mean, of course, it has been quite some time that the decision making has been really important, which is data driven. But that decision making has to be in the right direction, and that's exactly how we are trying to drive innovation in order to drive it in the right direction. So, thank you so much for that. The next
Correct.
one, how helpful is customer journey data in the fine tuning? When it comes to product that the company offers.
Right. So, Kruti, products are built based on certain assumptions, right? So initially you have a hypothesis, you feel that there's a problem statement, and then realize that maybe a certain product that you have in mind would fit the solution of that problem and solve for those assumptions. So that's the initial bit, right? But after that, there's a lot of iteration. You hand over your product to a customer, the customer uses it, you get feedback. Maybe it's short-term feedback. Sometimes it takes quite a bit of time for the feedback. Look at maybe something like a loan product that Lendingkart has, right? You get feedback on how your loan book is performing only after many months. right? But if it were about buying a book on a e-commerce site, you instantly get feedback about how the customer is using the product. So I think you collect data, and then you fine tune a lot of what the product is doing with that basis that data, and the understanding of the customer problem, right? And letting the customer own the problem, right? And then using this data to have a solution for the customer is what most people do, right? And there's a lot of innovation there. That's how there's customer journey data that comes in, but sometimes the customer themselves may not know the problem. And think about a scenario where you probably cannot talk to a customer. Your customer is anonymous, and probably they are a very large cohort of very diverse set of customers. That's where customer journey data comes in very handy in fine tuning the product. And data is not just numbers, right? I mean, data is really behavior, and we try to codify this behavior in terms of numbers. Examples could be how much time is someone taking to fill in maybe a form, right? Or when there is a button on after filling a form, is there some other box out there which looks like a button which someone is trying to click? Are the customers having to scroll too much, and is there fatigue in probably accessing the service that you're trying to provide? So a lot of this is sort of codified into numbers as funnels, and that goes into problem solving, saying that okay, we have a funnel drop from step A to step B, and you hypothesize again. Then sometimes it becomes very visual. You watch a video of what the customer is doing. Now that is data again, right? It may not be numbers, it may be video, but it's data nonetheless. So across the funnel, you look at things and then you build in interventions. Now once you build that intervention, you don't know whether that intervention will work or not. So that's where experimentation to gather more data comes in. You probably want to do A/B testing, wherein you select two cohorts, and then you say that, hey, I'm going to serve a particular cohort with a kind of experience, another cohort with another kind of experience, and you see maybe there is improvement in the conversion or improvement in the way the customer behaviors as they go through these particular intervention. Now, and that's how you iterate over the product and you improve it, right? Now, if you could sort of stretch this to an extreme as well, you could say that I'm going to serve multiple experiences to multiple cohorts, or you could say that I know this individual customer very well, and hence I'm based on the data that I have, I will deliver the product to them in a very specific fashion. So that personalization, hyper personalization is again something that comes in when we look at data, and this is how you would use customer journey data to fine tune the products.
Thanks, Giridhar. And I think, when you talk about the behavioral data, I think that also changes with the due course of time. The customer behavior keeps on changing, and the analysis will also change for the organizations who are trying to actually analyze and then, bring in the innovation in the right direction. So I think that's a very, very important factor when it comes to the consideration of fine tuning the product and, with the final element that actually, makes it a finished product for the customers to use. And I mean, what are the different types of technology that companies are using to predict and minimize customer risk?
So there are several parts to risk, right? I think I would probably categorize into three areas. One is systemic risk, wherein is there danger to a very large ecosystem, right? Then there is organizational risk, maybe risk to a particular business, and there is individual risk, which is a risk to an individual customer and to their overall well-being. That could be their financial well-being. It could be their personal well-being. Both physical and psychological safety come into picture there. And when you talk about systemic risk, right? How do you deal with an entire ecosystem? Right, that's very important to look at. And when you're looking at organizational risk, we are looking at the risk to a particular company and the risk to the business. So these are actually interrelated, but not necessarily isolated, right? And how do we go about this, right? One is, let's talk about maybe systemic risk. Particularly in the financial sector, right? RBI works a lot in this area, and RBI has several working groups that work in this area. And Lendingkart is involved with some of these RBI working groups, and with organizations like Sahamati that are associated with the financial sector. They bring banks and financial institutions together. I give you an example of the account aggregator, wherein we are able to get data anonymized about a customer with their consent reliably and securely. So there are financial information users and financial information providers on their end. They come together, right, through these working groups, and then they take decisions that sort of impose a certain baseline, right, and ensure a certain behavior by these entities, all these organizations, that sort of takes care of systemic risk. And in some other areas, there could be a certain baseline that is imposed by the regulator themselves. Like RBI has this notion of systemically important NBFCs, and there are broad guidelines that they issue on IT systems, on technology, on data security, on governance, on business continuity when these systems are deployed, and the testing around that. So these baselines need to be adhered to, and that's how overall systemic risk is controlled. If you talk about organizational risk, right? I mean, maybe fraud is an organizational risk. Are there patterns in your customers doing something? How do you identify those? Again, to be able to identify patterns, there are techniques. Maybe if you want to understand links between entities and the way they are behaving, you employ graph databases. You employ time series data over time and look at how your customers are behaving, and that brings down the organizational risk. Now, there's a chance that you look at your own customers and say that, okay, this is the customer segment that I'm dealing with, and you might predict something that is very, very localized to you, right? And ignoring external factors. One example could be loan book performance of a company. Take the example of Lendingkart. What has happened to the customers who have not taken Lendingkart's loans, right? Are they also defaulting? And how can we bring in knowledge like that into our systems? So overall, I think, again, this is all data-driven decision making, and it plays a very important role in organization risk. And the third one I was talking about is individual risk, which is, again, you somehow need to give individuals the confidence, right, that their overall well-being is being taken care of. It's irresponsible for an organization to give more loan to a customer than what they can pay, right? So it's important that you look at data and take decisions appropriately. If your delivery mechanism is completely online, is your data at rest and in transit secure? What are the technological standards that you are adhering to make sure that there is suitable anonymization and storage? You don't want to keep data forever either, because you might take incorrect decisions over time when it's not relevant, and hence deleting that data is also important from an individual risk point of view.
It absolutely makes sense, Giridhar, and I'm sure when we're trying to look at the kind of cyber threats that are actually there and lurking around, I'm sure the audience, the customers, the end customers, wherein we have, the people who are making the use of these products in the end are themselves very much calculative when it comes to these risk factors. So it's a very important element. Tell me, how do companies assess the risk factors associated with the cash flows in customer banks?
Right, I think if you look at the most important risk, right, from an organization, from a company point of view, especially in the lending space, it is non-payment and your loan going delinquent, right? This is risky not just to the institution, but also to the customer. The customer might have forgotten to pay maybe an EMI, right? Which means that their credit worthiness will reduce. And that also affects the company's well-being financially, right? So I think that is the key aspect of risk that we look at, and companies that work in this space look at, Sukriti. And how would this happen in a traditional world, right? Let's take an example of maybe a two-wheeler loan or a home loan. There is this collateral there. there is some sort of guarantee that maybe a bank or an institution looks at. Now, can the collateral move around? I mean, maybe papers are forged and maybe someone sells away their home, right? Can a two-wheeler move around? For sure. Can it be damaged? Of course it can be damaged, which means that while you have taken some sort of guarantee in terms of collateral, there's a chance that you'll still have that risk, right? So of non-payment. Now, why can't cash be the collateral? If a two-wheeler can be collateral, at the end of the day, you're expecting that you'd be able to take the two-wheeler and then, recover the money. What if you go to the bottommost level and say that my cash is really the collateral? And where can I find cash? Right? I can find cash in the customer's bank account. Now, this is where the money moves in and out. So you sort of look at parameters there, like maybe the average daily balance. And then you say that in the first half of the month, there is much better average daily balance, and hence an EMI that a customer would be able to pay. There's a good chance that they would be able to pay in the first half of the month, and hence let us schedule an EMI there. That's for maybe 1 month, right? But you sort of have to look at a trend as well. Is there consistency over many months? Let me look at a 12-month period if it's a 1 year or a 1 year plus kind of a loan. Is there any check bounce in any of these, which means that the customer is being a little irresponsible. Pay slips is something that people tend to look at, right? What is the approximate expenses? Maybe you deduct saying that 60% is expense and then 40% is what someone would be able to pay back in terms of their loan. But really, is it 60% that they are spending, or is it 80%, or is this 50%? How do you understand that? So you have to go back again to the cash flow in the bank account. So there are positive features. Largely, they tend to be steady. There are maybe one-off negative features like check bounces. So essentially, this is how you look at money in a bank account. How is it flowing in? How is it flowing out? What are the features of the way the money is moving around? And then you decide on, okay, I'm probably able to give a certain amount of loan to a customer with a certain interest rate. And because there is a certain risk associated with maybe the way cash is moving in and out of the bank account, there's a certain risk score associated with them and a certain chance of default, probability of default. And you overall evaluate the risk of that customer based on the cash flow. It's fairly interesting, right? I mean, what I've sort of tried to explain a few ways we look at it, but then it tends to get more and more complex. We actually look at close to 10,000 derived data points on how money is moving in and out of a bank account to be able to arrive at customers' credit worthiness. Sukriti.
Thanks, Giridhar. I think that was so much useful information that you've shared with us today on how it's very important that we use data and then do the decision making when it comes to the product development, entirely when it comes to addressing the problems and the requirements based on the behavior of the products or in the lending space. So, audience, thank you so much, Giridhar. Thank you so much for being a part of this conversation. I'm sure our listeners will have a wonderful time listening to these information that you've shared with us today.
Thank you so much. And once again, thanks for inviting me, Sukriti.
Thank you. It was indeed a great experience for me, Giridhar, to speak to you. It's a wrap, audience. Thank you so much for tuning in. Stay tuned to TechGig for all the latest tech updates and happenings. This is your host signing off.